Yo, what's up, world? It's Hassan Minhaj, and forget COVID, China's got a new nightmare. A mortgage crisis so big it's making the pandemic look like a minor inconvenience. We're talking trillions of dollars in losses, millions facing foreclosure, and an economy teetering on the brink. Yeah, things are bad. Remember when everyone thought China was going to be the next economic superpower? Well, the party's over, my friends, and the hangover is brutal. This isn't just about numbers, though. This is about people, families who poured their life savings into these homes, only to see their dreams crumble before their eyes. It's about a generation questioning the promise of prosperity, wondering if the Chinese dream was just a big fat lie. Buckle up, folks, because we're about to dive deep into the belly of the beast. Remember Evergrande? That massive real estate giant that went belly up back in 2021? It was a name that dominated headlines, a company that seemed too big to fail. But fail it did, and spectacularly so. Evergrande's downfall wasn't just a corporate failure, it was a seismic event that sent shockwaves through the entire global economy. It was a wake-up call, a stark reminder of the fragility lurking beneath the surface of China's booming real estate market. Well, that was just the tip of the iceberg, the canary in the coal mine. The real trouble was much deeper, hidden beneath layers of financial engineering and speculative investments. Evergrande's collapse was a warning sign, a tremor that foreshadowed the earthquake to come. It was a prelude to a much larger crisis that would soon engulf the entire real estate sector. See, China's economy had become hooked on real estate, like a junkie chasing a high. The construction of high-rise buildings and sprawling apartment complexes became the lifeblood of economic growth. Local governments were using land sales to fund their operations, relying heavily on the revenue generated from these transactions to balance their budgets and finance public projects. Developers were borrowing recklessly to build more and more apartments, driven by the insatiable demand for housing and the promise of quick profits. And people were buying these properties at inflated prices, hoping to get rich quick. It was a speculative frenzy, a bubble that kept growing bigger and bigger. But the music had to stop sometime, right? The unsustainable growth couldn't go on forever. The cracks were starting to show and the foundation was beginning to crumble. And when it did, it was like someone pulled the rug out from under the entire economy. Property prices, once soaring, began to plummet, leaving a trail of financial ruin in their wake. Suddenly, those soaring property prices started to plummet, leaving homeowners in a precarious position. The dream of wealth turned into a nightmare of debt and uncertainty. Millions of homeowners found themselves underwater, owing more on their mortgages than their homes were worth. The financial strain was unbearable, leading to widespread protests and social unrest. The dominoes started to fall one after another, creating a chain reaction that threatened to bring down the entire real estate market. And the Evergrande collapse was just the first in a long line of casualties. Other real estate companies began to falter, unable to withstand the financial pressures and market downturns. The tremors before the tsunami had only just begun. So, how bad are we talking? Well, imagine this. You wake up one morning and your house is worth half of what you paid for it. The value of your biggest investment has plummeted overnight, and there's no end in sight. You start to wonder if you'll ever see a return on your investment, or if you're just stuck in a financial nightmare. You're still making those hefty mortgage payments, but you're basically throwing money into a black hole. Every month you watch your hard-earned cash disappear, knowing that your home is now worth a fraction of what you owe. It's a gut-wrenching situation that leaves you feeling hopeless and trapped. That's the reality for millions of Chinese homeowners right now. Entire neighborhoods are feeling the strain, with property values in freefall and no signs of recovery. The once booming real estate market has turned into a minefield, and everyone is scrambling to find a way out. Foreclosures are skyrocketing, with rates increasing by a whopping 150% in the last year alone. Families are being forced out of their homes, and the streets are lined with foreclosure signs and auction notices. It's a heartbreaking sight that underscores the severity of the crisis. And it's not just homeowners feeling the heat. The ripple effects are being felt throughout the entire financial system. Banks, both big and small, are starting to sweat as the weight of bad loans begins to crush them. They're sitting on mountains of bad debt, loans they handed out like candy during the boom years, and now they're left holding the bag. The pressure is mounting and the cracks are starting to show. They're scrambling to find solutions, but the options are limited. The once bustling bank lobbies are now eerily quiet and the employees are left wondering what the future holds. Regional banks are going bankrupt left and right, and even the big boys are feeling the pinch. The financial landscape is shifting and no one is immune to the fallout. The government is trying to step in with bailouts and whatnot, but it's like trying to put out a forest fire with a garden hose. The measures are too little, too late, and the crisis continues to spiral out of control. The future remains uncertain and everyone is holding their breath, waiting to see what happens next. Okay, so we've got a housing market in free fall, millions facing foreclosure, and banks on the verge of collapse. What does that mean for the average person in China? Well, for starters, it means jobs are disappearing faster than Bitcoin in a bear market. The construction industry, which had been a major engine of growth for decades, is now shedding jobs like crazy. And when people lose their jobs, they stop spending money, which sends shockwaves through the entire economy. Consumer spending, which was already slowing down before the crisis, has fallen off a cliff. People are tightening their belts, putting off big purchases, and generally bracing themselves for the worst. And who can blame them? When you see your neighbor losing their home and your friend getting laid off, it's hard to feel optimistic about the future. This, my friends, is what a full-blown economic crisis looks like. Section 5. The party's response: too little, too late. So, what's the Chinese government doing about all this? The crisis has been brewing for a while and the pressure is mounting. Well, they're certainly not sitting on their hands. In fact, they've been quite active, albeit in a somewhat reactive manner. They've been scrambling to contain the crisis, throwing everything but the kitchen sink at the problem. It's a full-court press. We're talking about interest rate cuts, which they hope will stimulate borrowing and spending. Financial aid to struggling developers has also been a key part of their strategy, aiming to keep the construction sector afloat and even trying to prop up the housing market by encouraging more people to buy homes. They're pulling out all the stops. But here's the thing, and a lot of people are saying it's too little, too late. The measures, while significant, may not be enough. The government's response has been criticized as being too slow, too hesitant, and lacking in foresight. Critics argue that the focus has been on short-term fixes rather than addressing the root causes of the crisis, which are deeply embedded in the system. And let's be real, the Chinese government isn't exactly known for its transparency or its willingness to admit when it's made a mistake. This adds another layer of complexity. So while they're publicly putting on a brave face, trying to assure everyone that they have it under control behind closed doors, you can bet they're sweating bullets, knowing that the world is watching and the stakes are incredibly high. Now, the Chinese people aren't exactly known for taking things lying down. They've got a long and storied history of protesting against injustice, even when it means risking the wrath of the Communist Party. And let me tell you, the mortgage crisis has sparked a wave of protests across the country. From Shanghai to Shenzhen, people are taking to the streets, demanding government action to halt foreclosures and provide relief to struggling homeowners. But here's the thing about protesting in China. It's not exactly a walk in the park. The government has a zero-tolerance policy for dissent, and they're not afraid to use force to silence their critics. So, while the world may not be hearing much about these protests, trust me, they're happening. And they're a sign that the Chinese people are fed up, they're angry, and they're not going to take it anymore. Now, here's where things get really interesting. The mortgage crisis is happening against the backdrop of a major generational shift in China. Young people, those born after the one-child policy was introduced, are increasingly questioning the traditional Chinese dream of owning a home. They're saddled with student debt, facing a hyper-competitive job market, and they're looking at the housing market and saying thanks, but no thanks. Instead of pouring all their money into a down payment, they're choosing to rent, to travel, to invest in their own businesses. They're prioritizing experiences over possessions, flexibility over stability. This generational shift has major implications for the future of the Chinese economy. If young people aren't buying homes, who will? And what does that mean for the construction industry, the banks, and the entire economic model that China has built its success on? Now, you might be thinking, okay, Hassan, this is all very interesting, but I don't live in China, so why should I care? Well, my friend, here's why. China's economy is so massive, so interconnected with the rest of the world, that when it sneezes, the rest of us catch a cold. We're talking about a global economic slowdown, falling stock markets, and even political instability in some countries. Investors are pulling their money out of China faster than you can say yuan devaluation, which is bad news for everyone. And let's not forget about all the countries that rely on China for trade. When China's economy slows down, so do their exports, which can have a ripple effect throughout entire regions. So, yeah, this isn't just China's problem anymore. This is a global crisis, and we're all along for the ride. So what does the future hold for China? Honestly, nobody knows for sure. Some experts are predicting a prolonged recession, a lost decade like Japan experienced in the 1990s. Others are more optimistic, believing that the government will eventually get a handle on the crisis and engineer a soft landing for the economy. But here's the thing, the Chinese government is facing a dilemma. They can either continue to prop up the housing market and risk creating an even bigger bubble down the line, or they can bite the bullet, let the market correct itself, and face the short-term pain of a recession. It's a tough choice, and the consequences of getting it wrong are huge. So stay tuned, folks, because what happens next in China will have major implications for all of us. Peace out.